Hi, this is Mike Maloney, and I'm joined once again by Jeff Clark and Adam Taggart. Jeff, what have you got for us today?
We've got lots to go over, our usual slate of things, Mike. So, Adam, thanks again for joining us this week.
Highlight of my week, guys.
Article of the day, tweet of the day, chart of the day, a great, some wonderful viewer feedback, and a great meme. So, stick around for that. So, guys, we're going to jump right in. And this first for our article of the day actually appeared on CNBC. The title is Forget Gold. There are better ways to play precious metals, according to one CIO, Chief Investment or Information Officer. Now, this article, to be honest, isn't that great. It's just a journalistic piece about, a journalist interviewing a CIO about why he likes gold and silver. The reason we're bringing it up, though, is because this appeared on a very mainstream article, a mainstream source. And it talks about why this guy likes gold, but why he likes silver even better. So it's very interesting that, a buy silver message appeared on a mainstream journalistic piece. So, Mike, what was your reaction to seeing this?
Well, that says that, there's three stages to any market. And the first is where the public, the general masses, think that you're crazy for being in it. That's where it was when I jumped into precious metals in 2002. Everybody thought I was nuts. So the first phase has tremendous doubt, and everybody does not believe in the market, and it's only the really smart money that moves in at that point and takes a position. And then there's a second phase where it starts to get some notice and starts to get written up and starts a legitimacy, and people start believing in it, but most investors still don't do it. And then there's the third phase, the blow off top, the final phase, where it's the no lose, where you just buy real estate because it goes up forever. Back in 1999, buy tech stocks because the .com, this is going to go on forever. This is the hot, and that's when everybody gets slaughtered. So there's three phases. And this shows that silver is finally getting some notice. This is the first one we've seen on really mainstream press here. This is CNBC. And, it says, basically the title should be Forget Gold, Buy Silver. And then down here in the bullet points, right below the beginning of the article, it says over the last year, gold has risen 4%, while silver is up over 70%. Well, part of that is what happened during the market crash of the pandemic. But silver always exaggerates whatever gold is doing, whether it's rising or falling. So I found it not a great article and not really well written. It's written by somebody that really doesn't know that much about it, just reporting on the answers she's getting from somebody she's interviewing. And but it's excellent. And the very fact that this is getting written up on the mainstream is amazing and confirms that we're in that second phase of silver's big bull market. What do you think, Adam?
Well, I think, her focus on silver was it's a commercial product, it's a commercial metal, and commerce is increasing in the recovery here. And she's not wrong with that. There's a couple really important points that underlie that. One is increasingly we're finding that the success of the digital economy, the Googles, the Amazons, the Apples, et cetera, is increasingly becoming limited by constraints in the physical economy, like the actual infrastructure and distribution and transport systems that they have been either underinvested or they just can't keep up with the growth of the digital economy. And so that's where a lot of investment is going to be going forward. And, if you just look at President Biden's recent $2+ trillion American jobs plan, it is filled with green projects, I think like 174 billion to quote unquote win the electric vehicle market, another 100 billion to re-energize the US power grid. Both of those are going to require a lot of silver because silver is the best conductor that's out there. So I don't think she's wrong. I think there actually is going to be a lot of commercial demand flowing into the silver market at the same time that we believe there's also going to be increased demand for it, on the monetary side to protect against all the currency inflation that's going on out there. One thing in the article that she was saying, gold's the bloom's coming off of gold because interest rates are rising and higher interest rates are bad for gold. She's missing an important half of the equation, which is really what matters for gold is what the real rates are. And if if the rate of increase in inflation is outpacing the rate of increase in interest rates, which I think we believe it still is right now, then the actual real rates are negative, and that's actually really gold positive. So while I think she actually makes some good points about silver in the article, I think she kind of misses the boat on gold by missing the real interest rate factor.
The other thing about the interest rates, though, it isn't just real rates, but it's real rates plus what does the public, what do investors think about what the Federal Reserve is doing? Whenever they create huge currency, whenever they take interest rates further, down or negative, how does the public feel about the manipulation of the economy? And then when a crisis happens, you add negative real rates plus
panic.
Plus panic, right? Those are multipliers. And then to speak to your comment about the economy, that the government is going to do all of these green things that are going to use up a lot of silver. That's true. And in a growing economy, that would be that would be good for silver. But if there's also a crisis, this is government mandated spending that will happen. They're just going to create the currency for it. So it creates an artificial demand for silver, but most silver comes from mining base metals. And so if there is a simultaneous collapse in the markets, if there's a crash, if there's a big pullback in the economy, it means that there will be less car batteries being made, so less lead mined, less pipe for plumbing and copper wire for electricity, so less copper being mined. All of the base metals would have the base metals that have silver as a byproduct. That supply would go away just as demand is going up because of monetary demand, plus this demand that's artificially being created by the government. That's a really good point. I hadn't even thought about this artificial demand created by the government.
Yeah, and what's kind of interesting, Mike, is silver almost is sort of like having a straddle. It's almost like having a put and a call option. So in other words, if all of this new, government stimulus goes into these infrastructure programs, then that's going to, boost up the demand for silver and other base metals and whatnot. But on the other hand, if we have this sort of breakdown in the system that we think might actually happen, that benefits silver as well, because as you said, all the mining of all the base metals and everything stops and the supply shrinks. So silver is such a fascinating asset because it has all of these different elements to it.
We shall soon find out if silver's second phase has kicked in, so stay tuned. Well, guys, on to tweet of the day, and this is from Galactic Trader, and he says the Comex registered silver he's referring to, registered ounces, hemorrhages 2 million more silver ounces and 1.9 million ounces is out of the vault, implying that it's been delivered on. Registered is now down to 32.5 million ounces, or 22%, since the start of the silver squeeze. The Sprott Fund now has 20.9 million ounces more silver than the Comex. And you can see this chart he shows here that, yes, Sprott's fund now actually holds more silver than the registered ounces at the Comex. This is quite amazing. So there's still the eligible category at the Comex. Registered is what can be taken delivery on immediately. And that category is actually now lower than the Sprott Fund. So what's your reaction to seeing this?
Yeah, I look at the chart, and to me, it shows it's one of those where a picture is worth 1,000 words, right? It shows that the little guy actually does have collective power. You look at that chart, that very attributable to the first silver squeeze. So it actually did make a real difference in beginning to drain inventory out of the Comex. And sometimes when we're individuals taking action, we're not really sure that our one little step really matters. Well, this shows collectively, if you participated in that first silver squeeze, it actually did, and it actually made a real difference. And so I think, as we have this second silver squeeze coming up, and who knows, maybe there'll be more in the future, I kind of ask myself, like, well, we look at the impact of that first one. What percentage of US households were participating in that? I think it's a fraction of 1%, right? So, but it had that much effect. What would happen if twice as many people participated this next time round, right? What if this actually becomes some sort of popular phenomenon and we get 1% of the population doing this? I mean, it could really break the Comex system easily at those levels. So I guess my comment on this to folks watching is, hey, if you're participating in this, you're making a difference. And if you're not participating in it, but want to make a difference, join on in.
When you said 1% of the population, there's your triple digit silver right there. I just don't see how silver could stay below triple digits if 1% of the population tried to squeeze into this minuscule little market, because it is a tiny market.
Tiny it is indeed. And that's one reason why it's so volatile and why we're convinced it's on its way to triple digits. So, well, if you're liking this video, please hit that like button down there below for us, and the notification bell as well. So, well, guys, on to chart of the day here. And this chart says still cheap. U.S. debt service costs are historically low, though set to rise. And what this is basically talking about is the amount of currency that must be paid on the bonds that the U.S. issues. They have to pay interest on that. And it's showing that it's low now, but it's set to rise, which is the opposite of what happened under Reagan and Volcker back in the 80s. So now this is generated from the CBO. And I think Mike will have an opinion on that. But Mike, what do you think about this idea that interest costs are set to rise?
Well, yes, they are set to rise. You commented that the chart's from the CBO, the Congressional Budget Office, and they have pretty much a record of just being wrong, and wrong. They get it so wrong all the time, and their forecasts are always way too rosy. The forecasts for the size of the national debt, the forecasts for the deficits, and basically, so this is the interest on the national debt. This is what we've got to pay to always refinance the debt, and it's forecasted to rise out in the future. And I don't know what interest, this rise that they're showing is probably just what's going to be due on this increase that we're having in the national debt. But are they projecting permanently low interest rates, that the interest rates are they're always going to be just 1% or 2% on longer term bonds and practically zero on short term notes and bills? I don't know, but I know that when you compare the results to when you compare the reality of the results a few years down the road to what they said it was going to be, it's laughable. They're wrong.
I'll just join on that. So I interviewed David Stockman last week. And for those that may not be familiar with him, he was a former U.S. congressman. He was actually Ronald Reagan's director of the Office for Management and Budget. And man, I mean, it's harder to find somebody who's a bigger critic of what's going on right now in Capitol Hill than David. And he was just blown away by the government's response to the coronavirus, where he said, if you look at the impact it made on GDP, the coronavirus, the shutdowns, et cetera, kind of blew an 800 billion hole in GDP. And the government decided to fill that with over 6 trillion in stimulus. And that's not even including the stimulus bills that haven't been brought into law yet, been enacted. So, government over response, you might argue. But when we add up all those stimulus packet programs, some of them are being done by the money being issued by the Federal Reserve, which is what's called monetary stimulus. But a good chunk of that increasingly is money being spent by Congress, which is what's called fiscal stimulus. And fiscal stimulus, it really is Congress borrowing that money. And so that is new trillions and trillions and trillions of dollars since just last year that we're going to have to be servicing that debt interest going forward. So, unless interest rates really stay zero, these borrowing costs have to rise. This debt service chart has to go up going forward. And Mike, you said, and you're very accurate, those estimates there by those government organizations are always wrong and always consistently wrong to the downside. So, these trillions of new debt, the piper is going to need to be paid. And once rate starts rising, and we all think that, we've gotten used to the fact that they haven't risen, and we seem to think, oh, the government has it under control. The market can take the interest rate away from the central planners. It's definitely happened at many points back in the past. And we're seeing rates rise now, despite all this stimulus that's been going on, which is an early indicator that they may be losing control of this. And if they do, given all that new debt, those debt service costs have to rise going forward.
Yes. One of the things you were talking about is these multi-trillion-dollar programs that create base currency, basically. The Fed has to create these dollars to support these programs. I want to sort of remind everybody that the currency supply before the crisis of '08 was about 0.8 trillion, 0.8 trillion, not 8 trillion.
Right.
And so to have any government program or be going out to borrow currency, issuing bonds, and to have a program that's 1.6 trillion, if it's measured in the trillions, it's totally insane. And it just shows you that we are in the middle of this giant car crash, but we have not yet had the collision. We're just out of control at this point.
Yeah, great input, guys. So, well, on to some viewer feedback. This is from Zenity. The employees at the Fed must be like frightened meerkats at the moment, busy scanning the horizon for the next black swan event that they caused. Is that right, Mike?
Yes. The Federal Reserve, judging from their actions, Powell comes on TV and he looks calm. But I guarantee you that there is a sense of panic, and their only solution to anything is to blow a bigger bubble. And there will come a day where the market overwhelms all of their manipulations. And on that day, there will be the other half of the 2008 crash that they won't be able to control. And it's going to be much, much worse. I think it's going to be one of the biggest events in history, simply because it's releasing all of the energy from their manipulation. It's overwhelming their manipulation. And so I would expect contractions, if they're not comparable to the contraction from 1929 to 1932, it's going to way surpass it. So I'm sorry I'm laughing, because this is a tragic event and it's going to make everybody, but like I've said before, if you can't laugh about it, you got to cry, because what they've done to me is just totally insane. People don't trust the markets enough to think, well, what would have happened back in 2008 if they hadn't manipulated things? Yes, the markets would have crashed a little bit more, and then they would have reached an equilibrium, and they would have bounced back from a realistic level. But they say, oh, look, we saved everybody. Our methods work. We were right. And they are just so wrong.
Well, on to quote of the day here. But first, if you've not read Mike's book, you can do so for free. The link is below. And subscribe to Adam's new exciting Wealthy On channel. The link there is below as well. So, Mike, give us this good quote of the day here.
Okay, I contend that for a nation to try to tax itself into prosperity is like a man standing in a bucket trying to lift himself up by the handle. Winston Churchill. This is absolutely true. It has never worked, but now we're going to try it again.
Right.
Thanks, everyone, for watching. Thank you, Adam. Thank you, Jeff.
We'll see you guys next time.
A great time as always, guys. Thanks.